2025 macro webinar. I had a presentation prepared and I planned in advance because I had some travel over the course of the last week or so. And so I wanted to get ahead of the game and created a deck, and then this weekend happened. And not just this weekend and the shift in the tariff policy related to China, but also the continuing evolution of fiscal policy, put together really created a significant change in the policy environment that we've seen really emerge more concretely over the course of the last week or so. It was in many ways speculated on by many who were buying stocks. Um, the speculation being that there might be a significant relief going on, but it really only and it might be more expansionary fiscal policy, but it only really came into relief over the course of the last week. And so my preparation was of no use, and rewrote the presentation in time for today. I think before we get into the nuts and bolts of the policy, I think an important sort of framing that has at least been helpful for me through this period. Now, the first thing I'd say is it's very important as a macro analyst to divorce one's personal political preferences from an analysis of the macroeconomic consequences of policy and whether those things are priced into the asset markets. I've been doing this for a couple of decades, and I have repeatedly seen people falter when what they're doing is they're really focused on, what they think should be or what they would prefer to be rather than what is. And almost by definition, probably half the people who are listening to this, are probably have a favorable view of the current administration's policies, and probably the other half has an unfavorable view, almost by definition. And I'd really emphasize set that aside and try your best to, in an arm's length sort of diagnostic way, look at what the administration is doing. Similarly, in that vein, what I'd emphasize is that there's a lot of folks who have very strong opinions about, let's say, the psychology of the leadership and therefore the motivations and dynamics, and are essentially predicting what they're going to do as a function of that psychological analysis. And at least for me, what I can say personally is predicting politics is not the same as predicting macroeconomic consequences of policy. And that having skill in one does not necessarily mean that you have skill in another. And so there's a lot of people out there who are conflating essentially bets on political outcomes and frankly psychological outcomes of the current administration in making their bets, and they'll tell you all sorts of different tales. And trust me, I've read dozens of these. Everyone very confident that they understand the truth of the circumstance, rather than simply accepting there is a lot of ambiguity here about what exactly is going to happen with policy, and remaining open-minded and taking in facts about what are the incremental pieces of information that you're seeing, and then from that set of information trying to understand what its consequences will be relative to what's priced into asset markets. And so I think only by that process can you be flexible. You might be able to guess, and you might be right or you might be wrong in terms of what the policy path may be or the psychology, et cetera, but it's more likely that that's a function of luck rather than a function of repeatable skill. What you do have control over is understanding the macroeconomic consequences of the policy path that's likely ahead, and assessing whether that's likely to, sufficiently priced into asset markets. When I look at, this has been a tough time from a macro perspective, I think because in many ways there are two sort of core constituencies, maybe I'd say, with the new administration. One constituency I describe here as, pushing for accepting short-term pain in order to be in a better longer-term position. And, in many ways, that is the policies related there are, relatively high tariffs in order to raise revenue and onshore production, legislative policy around smaller deficits, and of course things like Doge cutting waste, fraud, and abuse at the executive level. And on the flip side, there's another, and I should say, and there in this sort of constituencies, uh, focus and views really can be summed up as lowering bond yields. That's really the focus that exists with that constituency. And on the other side, in many ways, there's a different constituency um, that is around a sort of growth stimulative populist approach. And that would include things like modest and targeted tariffs, that are nudging domestic production, but aren't necessarily, let's say, radically reshaping the international trade order. Uh, Things like tax cuts for populous areas like Social Security, overtime, tips, etc., and a focus on essentially deregulation much more deregulation to create disinflationary growth. And that really is more of a stock market focus in terms of measurement of success. And so I think coming into this, there's a real question about how these different constituencies would be prioritized since they both are, um, they are uh, both critical constituencies in the election, in the electoral victory of the administration, but they don't necessarily promote the same path. And I think basically what we've seen, you know, for the first couple of months of the administration was a real focus on the first, and increasingly seeing signs in the last couple of weeks of a meaningful shift to the second. And that's important because it at least what I'd say is you don't necessarily want to predict which one of these it will be. Some people have confidence that it'll be one or the other, but what you can do is look at the reality of the policies that are being pursued and understand the macroeconomic consequences given that set of policies. And so I think in a lot of ways we've shifted from the left to the right, and that has important macroeconomic considerations, which we'll talk about in a minute. Obviously, tariff policy is the biggest shift that we've seen, you know, for up until, to be frank, Sunday, tariff policy had been escalating. Tariff expectations had been largely escalating. And while there was a pause, that actually didn't de-escalate tariff policy all that much because of the significant escalation of tariff policy on China. And so it really wasn't until what we saw over the weekend where we saw a significant shift back in the other direction. And I think there's a couple of interesting data points related to that when you look at how that policy shift happened. The first is obviously moving from 145 to 30 is a big shift in terms of the tariff policies on China, but probably more interesting than that was the structure of that 30% was a 20% fentanyl tariff and then a 10% baseline tariff, notably the same sort of baseline tariff that existed with the UK. Um, and similarly, and in parallel, the Chinese dropping their tariff rate to 10% as well. Now, you don't necessarily want to globally predict the path of this, of what's going to happen, but certainly all rhetoric and structuring are pointing towards a move towards sort of that 10% ish tariff rate, excluding Canada and Mexico, which had been, previously excluded from, as part of the USMCA from a previous round of tariffs. And so you look at that and you say that would be a pretty big shift if we were to shift from the escalation that we saw up until Sunday to something that looks closer towards or moving in the direction of a 10% ex USMCA tariff rate, which is what you see over here on the right-hand side of the chart. Now, of course, a 7.5% tariff rate would be meaningfully higher than when we started the year and started the new administration, but would be a pretty significant difference in terms of what's likely to transpire, what the macroeconomic consequences are. And here, I think you've got you put this into context, which is we've moved from a place where we had the highest tariff rates in, more than 100 years to a tariff policy today that is, quite elevated. Um, but the question then becomes, what if we're moving, basically, if that's moving in the direction of eventually rolling off the Chinese tariff and sort of setting this, sort of sticking with this 10% baseline everywhere else, which is, the core part of the pause, then what you're seeing is something that is, moderate in size, meaningful in size, but not necessarily anywhere near as disruptive as what we saw, at the peak levels just a few days ago. Just to give some context, if you think about how tariffs can get absorbed, they basically can get absorbed in three different places. The first place is the manufacturer can reduce their prices, basically taking a margin hit. The wholesaler can reduce their prices, taking a margin hit, or the consumer can pay more. Those are the three places that a tariff can, have an effect. And at something like 145% tariff, essentially that creates an embargo because essentially no manufacturer will absorb that in their margins, no retailer will absorb that, and the consumer won't likely pay the elevated price except for critical goods. If you start to get to something that's closer akin to 10%, there's a lot of slack in the system in terms of manufacturers squeezing a little bit, wholesalers squeezing a little bit, and consumers seeing slightly higher prices. And so that transitions from a highly disruptive dynamic to something that's much more tolerable. And as a simple example, if you were to take the 10% ex USMCA tariff rate, which would be, essentially about 7.5% in aggregate, um, you'd be looking at something like a 50 basis point hit to US margins. And the reason why that is very important to recognize that tariffs are on the on the wholesale good, not on the retail price of the good, which is about 50% of the retail price. And so if you're thinking about, roughly what is the overall impact, that 10% tariff rate would raise, let's just say you just did the math very simply, which is, you took a 10% tariff rate on 50% of the cost, which is a 5% increase. And you say that, in US imports, again, just to use some round numbers, are about 10% of overall consumption. You've got something that is, not a drastic impact on the economy, something that, corporations could absorb through a little bit of squeezing of their profits, which are at secular highs. Or you could see a bit of a squeeze, a bit of a price rise for consumers. Here, we look at what it looked like at peak tariffs against what 10% ex USMCA path would look like. And what you see here is that if we're moving in that direction, that would be a modest inflation impulse that would probably hit consumer prices, and we're seeing that to some extent. Um, there's some good research just showing, the price changes based upon um, the geography of manufacturing for like products on Amazon and things like that. And you see, Chinese produced products have gone up a couple percent overall over the course of the last 6 weeks or so. And it probably take some time for that to fully flow through. But this is what you're looking at is something like, particularly from the Fed's perspective, it, it's not necessarily a desirable rise in inflation that would come from, a settling of tariff rates in this ballpark. But it's certainly not something that would create the significant risk that was being faced just a few days ago. From a revenue perspective, this would represent a modest increase in revenue, something like $200 billion. On this chart, what you see is you see a mix on the top hand side, you see the blended tariff rate, where 7.5% is roughly what it would look like if you did the 10% ex US MCA, a little higher, sort of between in the 10 to 15 range if you held China at 30. And you could see, the revenue, and then on the left-hand side, what you see is what the demand destruction multiplier is as a function of the tariff rate. So, the one meaning if tariff rates go up 7.5%, you'd have a 7.5% decline in demand, and it varies a lot by goods, and we could spend all day talking about it, but it gives you a rough range of what it would be. And what you see here is about $200 billion of revenue raised because, you also probably see some folks trying to get around the tariff as well. So it probably wouldn't be fully charged the way that it's represented here. And, $200 billion is something in terms of revenue raising, but it's certainly not something that would, be anywhere near what's necessary to offset a $2 trillion deficit, or certainly nothing near what would be needed to eliminate the income tax. And so I think what you see here across all of these different measures, whether we talk about corporations, households, or the government, is that this would be, if we're settling in this sort of new regime, essentially creating a national consumption tax on imported goods. It's a modest impact on the economy, but certainly nothing like what we were expecting to see up until the escalation subsided. And so I think it's important to recognize, when you're thinking about this from an overall GDP perspective, we basically, from a policy perspective, went from something that was likely to create a drag on the order of 1.5 to 2% of GDP to something that is essentially de minimis. Not zero, but certainly nothing like that level, and that can be absorbed through lots of different parts of the supply chain. And, policy changes, I'd say, that amount to something like 1.5 to 2% of GDP on a 1 year time frame are extremely unusual. They are extraordinarily large. They're extremely unusual. And so it's important to think about the macroeconomic implications, particularly the asset market implications of having such a radical shift in policy. Uh, Federal government policy today, assuming that we're, doing assuming what is being proposed is likely to be fulfilled, is much, much more expansive than it was just a few days ago. From a fiscal policy perspective, meaning a spending perspective, we also have learned a lot about what budget prioritization is likely to occur over the course, what the budget prioritization elements are going to be. And here too, there's a real question about whether we were going to see a budget that was going to include a significant amount of cuts of spending in various areas, or was going to shift over to the other side and look like something that's more akin to the populist views that existed on the campaign trail. And even as recently as sort of 6 weeks ago, the original House budget instructions included significant pay-fors for just the TCJA extension. Now, it's been very interesting what we've seen released at the end of last week with the Ways and Means bill, and then the sort of comprehensive, big, beautiful bill, what was announced on Monday, is a bill that in many ways creates a significant fiscal expansion in the near term, or over a term that anyone really cares about, and helps mute those headlines by proposing cuts in spending to happen out into the future, 5-ish years from now. When you think about that, what happens 5 years from now, who knows? Different administration, different people, who knows whether it'll actually be fulfilled. What really matters for the economy and for markets in the term that basically anyone really cares about as an investor is what happens in those near in years. And so in a lot of ways, I think the headlines can be confusing because people could say, well, the TCJA extension would add 4.5 trillion, give or take, to the deficit, and the big beautiful bill is only 3.4 trillion, and therefore, there's some pay-fors for the TCJA extension. And the answer is, like, that is a political commentary and political rhetoric. It is not macroeconomic commentary, macroeconomic rhetoric. What is proposed, which you can see here on the right-hand side, is uh, a pretty significant deficit expansion in the near term from a variety of different policies. And that's on top of the TCJA extension, which is not nearly as significant as that 4.5 trillion would suggest because it is current law, but it does include an extension of the TCJA, would include certain elements that would be modestly expansionary in terms of the deficit, say 50 basis points or something like that, 50 or 100 basis points. And so now we're adding another 100 basis points on top of what was already an expansion of 25 or 50 basis points. And now we're talking about a pretty significant expansion of the deficit, essentially going down this path, which is with this proposed outcome. Let's assume the big beautiful bill proposals, spending proposals, and tax cut proposals persist rather than do that goofy cutback 5 years from now. You're basically looking at tracking to roughly 8% of GDP deficits, um, in assuming normal economic conditions. And that is a pretty extraordinary deficit that we're likely to see, and important for two reasons. One, it puts pressure on issuance to continue to expand. And two, it is supportive to economic conditions. It is stimulative to economic conditions into an economy which is already, it's not booming, but it's certainly, absent this tariff issue, has been chugging along like fine. And so, with a relatively, with a labor market that isn't, again, it has slowed to some extent, but is by no means soft or weak, et cetera, with an unemployment rate, in the low fours. And so this is an injection. This is, you take this looks like a pretty big injection in terms of federal government stimulative policy ahead. And so you look at that and you sort of say, well, look, if you just go back to this opening framework and you look at these policies that are being pursued, this is not, it's not trying to read the tea leaves and understand all the nuances and try and do a psychological analysis. If it's just look at the policies that are being pursued, uh, and the path that's being laid down. And it's pretty clear what we've done over the course of the last, few months is we've gone from the left-hand side being the policy prioritization to the right-hand side being the policy prioritization. And that's coming at a time when you have, equity markets that, while of course in any valuation perspective are elevated, from a levels perspective, we're still below peak levels, and we're not that far off of pre-election levels, which suggests, that there could be more room to run upward to reflect this very stimulative policy. Even though stocks have gone up, but in a lot of ways they reversed the extremity of the post-Liberation Day announcement rather than reflect a transition to a more expansionary set of policy prioritization. And on the bond market side, with 10-year yields at 4.5%, that's certainly, we've seen higher levels in the last couple of years as a function of stronger economic conditions. And so, up to the fives. And so, neither of those things, while both are elevated, meaning bond yields are elevated to some extent relative to where they were, and stock prices and valuations are elevated, they're probably not reflecting the magnitude of the stimulative effect of this transition in policy away from, let's say, short-term pain for long-term gain to one of which I named Party on Garth as the sort of next the next description, the next environment that we're in. Party on Garth, for hopefully our millennial and Gen X viewers will appreciate that reference. If you're a boomer, just go ahead and you could go ahead and Google it. Let's talk about the Fed. This puts the Fed into a tricky situation because the Fed was on pause mostly because there was a lot of uncertainty. I think the challenge with this set of policies is that while it reduces the uncertainty ahead, what the most likely path that is emerging is one that looks like it's not going to allow the Fed to meaningfully ease policy anytime soon. And a big reason why that is because the Fed traditionally is reactive to backward-looking data. If you look at the backward-looking data, whether you're looking at core PCE, which is stabilized at 2.8%, give or take, with the most recent quarter into the threes, or you look at the unemployment rate, which is stabilized in the low fours, like nothing about either of these pictures would suggest that the Fed should be engaged in an aggressive easing campaign. The data that they look at is the data that they see, the data that they look at does not support meaningful easing in the short term. And then on top of it, what you're seeing ahead is expansionary fiscal policy and modestly inflationary uh, tariff policy. You put that together, and odds are you're going to see a hesitance in terms of actually delivering cuts. And it's notable because 2.5 cuts are priced in through the end of the year, which seems relatively significant in terms of the cuts compared to the set of economic conditions that it looks like we're facing right now. And oddly, for in terms of the structure, I find it odd that Powell's expected to cut a bunch over the course of the next year through the end of his term, but the new Fed chair is not expected to cut at all. When it seems pretty obvious that that the new Fed chair will have a lot of pressure from the administration to engage in cuts, and given the fact that they're going to be the one seated, they'll be seated by this administration. It is interesting that there's no cuts really penciled out ahead. So while the Fed, while we have a broadly expansionary set of policies, or a more expansionary set of policies than we expected happening um, in the federal government spending in particular, and less significant tariff policy than expected, it's not really clear that the Fed is going to go along, and that's important when you're thinking about, particularly from the bond side of things, unwinding a cut, something like 2.5 to 3 cuts expected through the end of the year or into early next year would be detrimental for the bond market and lift yields, combined with the fact that, and so this isn't like, quite as a no-brainer in terms of, where we were at other periods where the Fed indicated, that they were going to stimulate a lot, say the um the verbal pivot that happened at the end of 2023. It's not quite as pro growth of the environment as that, because the Fed is probably going to be easing off in terms of their behavior, whereas in that period, in the winter of whatever, December of 23, basically the Fed said we're going to ease sort of proactively into the economy, into an economy that was doing well. I'd say an undercurrent. So while conditions, at least for the U.S. growth environment, look better than where they were, as recently as a week ago, it doesn't mean that certain aspects of the previous wrecking ball views are not still relevant, and the most important of which being the idea that the U.S. and U.S. assets in aggregate remain significantly reliant on foreign capital, and that what we've seen over the course of the last couple of months are the sorts of behaviors and policies that have started those investors they've started to question whether it makes sense to be so overweight U.S. assets in aggregate. I mean, look, U.S. assets absorb something like 70 or 75% of every incremental dollar that flowed into financial assets over the course of much of the post-COVID period. Foreign investors, particularly real money investors like pension and insurance in Europe and Japan, financed 100% of the duration supply of the U.S. government in 2024, in the fiscal year 2020 that ended in September 2024. Those are huge capital flows coming into the US that are supporting US asset prices. And there's no real reason, let's say, why those investors should be so overweight US assets, both stocks and bonds, given this environment. And a lot of this, a lot of folks talk about sort of the reserve holdings and that being a big part of the story. But the reality is the reliance on foreign reserve holdings that really built up in the pre-GFC period. What's happened since the GFC has been a boom in terms of the holdings of US equities. And that's even more important because almost all of the flows that we're seeing into US equities from foreigners are unhedged, which means that the currency has a outsized impact on the realized return of foreign investors. And so many of those investors who have sat here through this year, and you might say, hey, look, conditions are looking a little better for US stocks. US stocks have rallied to some extent from the bottom, flat on the year, not so bad until you take into consideration the fact that the US dollar is down considerably relative to many of those currencies. And if you're sitting in Frankfurt, what you really holding unhedged US stocks, what you really care about is not the return in dollars, but the return in your own local currency. And that's what we see here, which is, a meaningful shift, a meaningful weakening of US asset prices, both the dollar and US stocks relative to foreign stocks in foreign currency terms or in matched currency terms, over the course of the last couple of months. These sorts of abrupt shifts are the sorts of things that, in many ways, they were driven by hedge fund money getting ahead and seeing the dynamics that were unfolding. But what they'll do is they'll start to create second and third order effects for real money accounts who will start to re-examine the amount of US asset exposure that they have. And so while the US is stimulating, and you may be getting a circumstance where US asset prices can hold up in dollar terms, the shifts, even a modest shift, right? This isn't, go totally back to, total home bias, even going from extraordinarily high flows into the US dollar assets to elevated flows into US dollar assets would be a meaningful drag on the dollar and on US asset prices relative to foreign asset prices. And so, we haven't even, if we look over a short term basis, we basically reversed maybe a year of asset price moves. But, US stocks are still up 40% relative to foreign stocks in the post-COVID period. The dollar is still up, 15 or 20%, depending on how you measure it, relative to foreign currencies in the post-COVID period. But really, when you look at it from a longer term perspective, this has been an extraordinary flow of capital into the US and out of foreign assets, with the US dollar exchange rate, basically real exchange rate at all-time highs, and with the US equity valuations relative to the rest of the world in matched currency terms at extremes that hadn't been seen, way above what was seen in the Nifty 50 and the internet.